Hello everyone, I'm Dr. Niranjini, and today we will be discussing a topic in financial management called the cost of capital. It is a core concept in financial management. So, before we go into the topic for today's session, let's first understand what is financial management. So, financial management, like different styles of management, this also involves the process of planning, organizing, allocating, and controlling the organization's resources. So, it can be referred to as a strategic plan of maintaining and controlling and organizing the finance of the organization in order to achieve profitability, the goals of the organization, liquidity, and maximizing the value for the organization. So it deals with three major decisions, which are investment decision, where to invest the funds, financing decisions, from where to raise the funds, and dividend decisions, which is how much profit to distribute to the stakeholders. It also ensures that the company is able to maintain its liquidity, it is able to balance its profitability, and also manage the risk. So, in simple terms, we can say financial management ensures that the right amount of funds are available at the right time at the lowest cost. So, it acts as a backbone of business survival and growth. So, in business, we call finance or capital as the lifeblood of business because without which a business cannot survive, it cannot be established. So, here I have listed several sources of capital for a company. It can be raised through equity shares, preference shares, debentures, retail earnings, and other sources of finance. So, what is cost of capital? Cost of capital refers to the cost of raising funds for business operation. It is the minimum rate of return that a company must earn to satisfy its investors. So, every source of finance has a cost associated with it. For debentures, it will be the interest rate. For equity, it will be the dividend or the opportunity cost or a share in profit that has to be paid back. For preference shares, it will be the fixed dividend. For retained earnings, it will be the opportunity cost, etc. So it acts as a hurdle rate in investment decisions. So if a project earns more than the cost of capital, then value is created. If the project earns less than the cost of capital, then the value is destroyed. So the financing and investment decisions are taken in um, accordingly. So, cost of capital can also be referred to as cost of raising such capital. So, the choice of the source is based on how much this source can increase the wealth or wealth maximization is possible. How much can this source stabilize the market value of the company? How we can manage the risk if we are going to raise capital through this source? So, depending on that, the choice of the source of capital is made. So, this is the definition of cost of capital. It is the minimum rate of return or profit a company must earn before generating value. Now, let's look at the example here. So, for example, you want to start a shop, a juice stand, and you want initial investment. So, you approach your father and ask for money. So, your father agrees to invest in your business and he gives you 2 lakhs as capital. And capital has a cost. It is not free money, even though you are related, they are still investing in your business. So, it is not free money, it is not a gift money, you have to pay back for the capital. So, he agrees to receive an interest of 3.5% on the 2 lakhs per month. So, there is a cash flow of 25,000 per month. The cost of capital, 3.5 percentage of 25,000 is 7,000 rupees. So this is paid each month to the investor. So the cost is the first priority to be paid back to the investor before meeting any other expenses. Even if it is reinvestment in the business, or even if it is principal amount which has to be paid back, the priorities should still be on paying back to the investor. Either the cost has to be paid back, right? So this is a rate of return expressed in terms of percentage, and it is the minimum required rate of return to offset the risk associated, to maximize the profit and wealth, and it has a role in maintaining the market value of the firm. So these are some of the components of cost: tax, historical and future cost, average, marginal and floating cost, explicit and implicit cost, depreciation, and so on. So, why cost of capital is important? It helps in capital budgeting. How you budget for capital each financial year. You can use cost of capital to understand if raising finance through a particular source is costly, or if it is profitable for the company. Based on that, you will be able to budget for your firm. It helps in determination of the capital structure. So some companies may have issued more equity shares and less debentures. Some company may issue more debentures and less of equity shares. Depending on their preferences, the capital structure is formed. It helps in the ascertainment of financial performance of the company. It aids in financial decisions, and there are various uses for stakeholders to ascertain the profitability of the company and to take their investment decisions. So these are the components in cost of capital. So basically we can classify it into four categories: cost of debt, cost of preference share, cost of equity share, and cost of retained earnings. Cost of debt can be classified into irredeemable and redeemable, and under redeemable it can be classified into lump sum or in installments. Similarly, cost of preference share can also be classified into irredeemable and redeemable, and under redeemable can be classified into in lump sum and in installments. So first we are going to discuss cost of debt. It is denoted as KD. So first we are going to look into the situation of irredeemable debentures. So under that, either the debenture can be issued at par value, which is the face value of the debenture, and before tax treatment. The next scenario is it is issued at discount or at premium, which is more or less than the face value of the debenture. And again here it is calculated before tax. So this formula will be used. And the third situation is issuing at discount or premium or at par. And here the situation is calculating after tax. So in this formula, if you notice, for after tax treatment, a simple component is being added, 1 minus t, right? So these are the formulas we will be using to calculate cost of debentures irredeemable. And here these are the formulas for calculating cost of debentures redeemable before and after tax, and finally cost of redeemable debentures in installments. So in the next video we will be discussing how to solve problems in cost of debt.